everyone, and welcome to Step Into My Office, Commercial Property Executives podcast series that tackles all things office and flex office related. Join me and industry experts in the field as we take some trips across major markets and delve into investment strategies and opportunities in the sector. I'm Olivia Bunescu, Senior Associate Editor, and for this episode, I'll discuss with John Anthony, SIOR, Executive Vice President and Managing Director at Kidder Mathews Los Angeles office. Anthony shared his insights about the market's current dynamics. Flight to quality, suburban migration, and the rise of flexible office solutions are influencing the space, fueling investors to redefine and recalibrate their strategy. Join us as we discuss the challenges and opportunities for Los Angeles' commercial real estate landscape. Hey John, thank you very much for accepting my invitation to step into my office. It's a pleasure to have you on the podcast.
Pleasure to be here. Thank you for the invitation.
For starters, I would like to know, how would you describe the current landscape of Los Angeles' office market and what sets it apart from other major markets across the U.S.?
I've been leasing and selling office space and office buildings in greater Los Angeles for 28 years. It's my core market, and of that greater Los Angeles market, the majority of what I do in the way of leasing and sales is the downtown Los Angeles market through the Koreatown market. And as far as the current landscape of Los Angeles goes, it's certainly going through an evolution, going through a recalibration. Post-pandemic, as we come back and we deal with the hybrid workforce and the new model, landlords are adjusting to it, as are tenants. Now, many tenants are still figuring out what that schedule means for them. Some are ahead of the curve, but those that are not are still working out how they're going to have or employ a hybrid workforce and work schedule within their offices, what that means to their overall office footprint. And the result of that uncertainty is a lot of short-term office solutions, a lot of people not wanting to commit long-term. And as landlords respond, we're finding that the market is slowly improving as people make those decisions and figure out what their long-term needs are going to be. But it's a work in progress. It's getting better, but it's getting better slowly.
I feel like that's the general consensus that could be applicable to other markets in the U.S. when it comes to office, because I've spoken to other experts on different markets that said the same thing as you just did.
What's new in one market for one office tenant is, for the most part, new for every office tenant in every market. And dealing with the new structure of the way a normal office day works and a hybrid workforce is something that we're dealing with across the board. Now, here specifically in Los Angeles, we're seeing a few things come from that. We're certainly seeing a flight to quality. That's a real thing. Those office tenants that are ready to commit and have figured out what their footprint needs are generally looking to upgrade the quality of their office space and the quality of their office building. The economics are such in most submarkets that they can upgrade without increasing their monthly occupancy costs. So there is a flight to quality among the office tenants in Los Angeles. Another thing that is happening is there's somewhat of a flight to the suburbs. There's not as much demand to be in a core central business district. If they're able to be a more campus type environment in a submarket that's in the suburbs, that's maybe closer to their employee base or at least closer to the management space, where they can have more a flexible and open office environment versus that of stacked in a high rise in a major central business district. We see a trend towards that. It's not overwhelming, but it certainly is happening.
Mm-hmm. I was about to ask you if there are any demographic shifts happening in the Los Angeles office market, and how are those trends influencing the demand? Do you see any submarkets emerging as new hotspots for Los Angeles?
Demographics aren't changing much. Certainly the biggest effect we're having here in not just Los Angeles, but California is the flight of office tenants outside of California. The relocation of many of our tenants to other states with municipalities and state government and tax incentives that favor those that are so high and penal here in California. States like Texas and Arizona and Nevada, to name a few, have really capitalized on a migration of office tenancy from California to those states because our taxes and our lack of incentive and frankly the lack of our municipalities and our state government in supporting what they're doing and providing reasons for them to stay. So the real shift that we're impacted with here in the state of California and within the LA market is too many of our larger tenants that have the ability to locate their offices anywhere they would like on the West Coast, opting that not to be in California, versus there are certain office tenants that have to be here and will remain. But if they've got the option, most are picking to leave California and leave Los Angeles, and that's a problem.
Right. Could you speak a bit about the tenant roster in Los Angeles? Who are the main tenants occupying the office space? And if there are any branches on the rise currently?
Well, for a very long time, we could point towards government as being our biggest tenant and a tenant that's consistently counted on to extend their leases and grow. That's certainly changed with the federal government and the new administration and what they're doing to cut back on waste. And we've seen the federal government's office footprint here in Los Angeles shrink for the first time since the 28 years that I've been leasing space, and I've done a tremendous amount of leasing with the federal government here in Los Angeles. They've certainly become more discretionary on what their needs are, and there is a shift towards efficiency there that's happening, which has negatively affected the absorption within the market from the GSA, which is the real estate arm of the federal government. The state, the county, the city, you can always count on them increasing their footprint, and that's happened, but not to the degree it's happened in the past. The main driver here in LA is media, and with the media and entertainment being hit so hard by the decisions and the economic policies of our city and of our state, not incentivizing them to stay here and film here and produce here, when so many other states are offering huge incentives to do it elsewhere, the media footprint here in Los Angeles has shrunk, and that's been certainly a driver. Markets such as Burbank, they've been devastated by it, but LA in general, we're an entertainment hub that is shrinking presently, and that's got to be turned around.
I'd like to discuss a bit about the development activity that is down nationally due to the economic volatility. What are the main challenges developers face today in the Los Angeles market and the broader area?
When it comes to office development, you can point to one thing to begin with, and it's the most important, and that's demand. If there's not demand to fill in a new office development, then why build it? And who's going to lend on it? And who's going to invest in it? The demand is down. We have a lot of vacancy that still needs to be absorbed. We have a lot of second-generation office space that needs to be backfilled. And with many of the recent sales that are resetting the basis on those buildings, landlords are becoming more aggressive across Los Angeles about the concession packages and the rental rates that they can offer. So if you're a developer underwriting your new office development based upon best-in-class market conditions and rates, and there's, in many cases, millions of square feet of space you're competing against, you want to see that absorption happen first. You want to see the amount of vacancy drop before you're going to spec office space. So demand is the number one driver. It's why there's very little new office development here in Los Angeles, followed by, again, our policies here in the state where we're not, and certainly in Los Angeles, where we're not providing enough incentives for those investors and developers to come in and build office. We're not business friendly like we should be, and hopefully we see a shift there. And I'm certainly not a believer that it's going to stay status quo forever. Right now, we've got to make that shift, being a more business friendly submarket.
And talking about the economic volatility and demand in general, how are investors recalibrating their strategies in the Los Angeles office sector? And what risk factors or opportunities are they watching most closely?
Well, we can fall back on what I just said, which is demand and vacancy. If there's a lot of vacancy and there's low demand, that's not the environment in which you're going to build new office. And many of the assets where the debt is rolling over here over the past year and in probably the next 24 months to come, as those loans come due and there's the reality sets in on what the absorption and what the new economics are as far as rental rates, we're seeing these buildings retrade, and that's a good thing. Obviously, if you're the one owning the building and you're either losing it to the bank or you're selling it for, in many cases, 30 cents on the dollar, it's tough for you. But for the market in general, what we have is coming in a new class of owners and landlords that have a low basis and are able to offer lower rental rates and better packages that will have tenants choose our submarket versus other submarkets. That'll lead to absorption, and eventually we'll see the market reset, the office market heal, and start that trend towards less concessions and higher rents. And it all starts with resetting some of these ownership's basis in their assets.
You mentioned that flight to quality was one of the main things attracting investors and one of the main trends in the office market. What are other particularities driving investor interest in the Los Angeles office market? Because according to our in-house data, the Metro ranked the third nationally for investment volume in 2024. Do you see any?
Certainly, it's price per pound. So if you're coming in, let's look at downtown LA as an example of the Los Angeles market. If you're able to come in and snatch up one of these Class A high-rises for, in some cases, 20 cents, 30 cents on the dollar, which is happening, and your basis is now closer to $100 per square foot to $150 per square foot, with some exceptions, and those towers were underwritten in the past at $300, $400+ per square foot, it's seen as, okay, yes, there's not a lot of demand. Yes, there's a lot of vacancy, but I can go pick up this asset for 20 or 30 cents on the dollar. And then when the market improves and I'm able to do some significant leasing, the upside is great. And I'm willing to take that risk in the short term, because long term, I feel that when it does bounce back to where it was, I have the ability to do very well with my investment. So that's the driver. It's price per pound. It's price per square foot. It's where their basis is versus where they think it will be in the future.
Mm-hmm. And I'd like to go a bit back to the creative sector in Los Angeles. Do you believe that the diverse and creative environment help buffer the office market from broader economic challenges? Does it play a huge role in that?
Yeah, it's certainly helpful. We have a lot of creative office opportunities in LA, and certainly there's a big demand for creative space. LA is really unmatched in its diverse economy. There's a lot of strong industries that are creative. We talked about media that like that creative type space, of things like campus type environment or slab floors, open ceilings, that type of product. There's a demand for in LA. People like it. We have quite a bit of it to help meet that demand, but not enough. So we're seeing more and more creative space hit the market as far as office goes, and see greater demand over that of, let's say, Class B office. If you're sitting in Class A, well-amenitized office right now in Los Angeles, you're feeling good about where you're at in the future. You don't love it, but at least you see a bright future. If you've got low amenity Class B typical office space that's not creative, you're in a bad spot right now, because there's a lot of options tenants are going to choose ahead of yours that are creative and or Class A and highly amenitized, with things like shared conference facilities, gyms, open space. That's what people are looking for. That's what they want. And if they can't find it in your Class B building, they're going to upgrade and go to one where the economic change is not much for them as far as rental rates. and grab those amenities in that type of environment because that's where the demand is.
Yeah, the flight to quality movement, which is,
Yeah.
we just got our office upgraded, so
Yeah.
here in Romania, yeah, we they renovated it, so it looks
Yeah.
better. It has more natural light. So
It feels better. And maybe 5 years ago, it would have doubled your rent or maybe 50% higher on your rent. But now people are making those upgrades at the same rent or slightly higher. So a flight to quality is real, and there's a demand for it.
yeah. After a short break, we're going to come back to the flex office dynamics in Los Angeles and some of the challenges investors face nowadays.
Hi, this is Jessica Feuer, Editor-in-Chief with Commercial Property Executive. I just wanted to make sure you know that the entries for this 2025 CPE Influence Awards are now open. We're ready to hear all about your most noteworthy properties, projects, and transactions. Does your office have unique design elements that attract tenants? Are you the top broker at your firm? Were you able to successfully reposition a property? We want to celebrate your successes. Email me at jessica.feuer@cpe-mhn.com and I'll guide you through the entire process. The entries are due June 6th, so you have plenty of time. Thank you.
I'd like to discuss a bit about the flex office market. I wrote an article at the beginning of this year about the top 10 metros for co-working space, and Los Angeles leads the nation in flex office locations and ranks really high for co-working space footprint. From your perspective, how is the flex office market evolving locally, and what's fueling the rise of co-working in Los Angeles?
It's certainly accurate. The demand for flexibility has never been higher that I've seen in my career. And it leads back to what I said earlier with regard to people still figuring out the hybrid workforce, still figuring out what their office footprints needs are going to be now and in the future. So if they have the ability to get into an environment with maximum flexibility, by that, maybe renew just for a year or just for a very short term, figure these things out. Or if that short-term renewal is not on the table, move to a executive office type environment or flex environment where they can have maybe some shared meeting rooms. Do they need them or not need them? They can use them at will, but the leases are month to month or 6 months, a year tops, and figure these things out. There's a demand for it. And then if you're a small office tenant, you can have a smaller footprint where you share a lot of those needs like conference rooms and reception and workrooms and kitchens that you would all house within your suite are now shared, let's say, amongst a floor in an executive suite environment. Your footprint's smaller. Now you're paying for those extra services, but what you're buying is flexibility and the ability to, as you grow and as you figure out what you actually need and as your economic future becomes more certain and you become ready to make long-term commitments and decisions, you can then make those on a dime because you're in a flexible environment. So the demand for flexible space, the demand for executive offices is strong, it's steady, and it's increasing.
Did you notice a trend of this spacing being incorporated in traditional landlord portfolios as well? The buildings that you mentioned earlier, for example, the Class B buildings.
Yeah, I have more of my clients, certainly. I'm working on 2 executive office deals right now where in the past these landlords would say, wait, let's find a traditional office tenant for this old law firm floor that has a ton of private offices and workstations. They're saying, hey, if you can bring in an executive operator, John, we're going to be in some sort of shared revenue model, and it's maybe a year-to-year type deal where I can get out of this lease with a year notice when the market improves, and I can, in the meantime, have cash flow on a space that would sit vacant. More and more of my clients, as they should be, are being creative and being flexible, and they're going to go grab that opportunity. So, yeah, I see a rise of flex space. I see a rise of executive offices. Now, you've got your big national operators, of course, the Regises of the world that are looking only to go into trophy buildings with all the amenities. But there's a next level down of a more local operator that is more of a revenue sharing versus a leasing of a floor type environment. And those are the ones that are in the market looking and active.
Mm-hmm. I'd like to move on from flex office and ask you about if you noticed a resurgence in the use or redevelopment of historic buildings or buildings in Los Angeles. If so, how are these properties being repurposed?
Well, we certainly went through a big renaissance from 10 to 15 years ago, maybe even 8 to 15 years ago, where we saw a ton of historic buildings purchased, get either converted to apartments or converted to creative office. And a lot of those investors and projects did really well. Are we seeing a lot of old historic buildings make that transition currently? No, we're not seeing a lot of it. It's really expensive to do the change of use and transition them into, let's say, residential from office, make the conversion, very old office space to creative office, and create the type of environment where tenants are going to want to come there. The construction costs are exceedingly high. Dealing with the city is as challenging as ever and as expensive as ever. So, and there's a lot of vacancy and there's not a lot of demand, which means why are we going to take on this huge project with so many headwinds in this type of environment? So no, that's slowed down considerably. It'll change when the market gets stronger and when there's less vacancy and more demand. But in this environment, if you're an old historical building with very old office space, you're in a very tough spot. There's not a lot of solutions to you currently.
All right. I have one more question for you. What are your key predictions for the Los Angeles office sector over the next few quarters, and what should the industry be watching out for?
Well, demand is the biggest, right? Here in Los Angeles, if there's demand, then there's always going to be investors that will build it because it's Los Angeles, beautiful weather, diverse workforce. People want to live here and work here. So with demand, the investment, the development, all that will come. And what we're doing is we're really keeping track of the workforce model, and as companies implement hybrid workforce and work days and how that affects their footprint and when they're going to be making those decisions and ready to commit long term. As that starts to heat up, we're going to see demand heat up. As our city and our municipalities and our state government starts to get behind business again, that would help tremendously. We can't afford to keep losing our office space to competing states. We need to keep them, and we need to get more competitive, and we're tracking that closely, certainly hoping and encouraging our government to do so. So those are probably the two main factors that we're keeping an eye on, and as those improve and change and evolve, the market will as well. Certainly there's light at the end of the tunnel. I believe we've bottomed out and we're headed back up, but it's slow going and in the early stages.
It was a very interesting conversation. So thank you.
You're welcome. I appreciate the time and the opportunity.
Thank you for stepping into our office. Stay tuned for the next episode of our series in July, and feel free to rate this one if you've enjoyed it. For more commercial news, trend stories, and podcast episodes, visit cpexecutive.com. Have a great day, and we can't wait to see you on our next episode.